Dear friends and investors, at the outset, wish you all a very happy new year. This is the first communication of the year, and we will talk about a few things that are top of mind. One is that we have seen a lot of chatter about worries and challenges in the economy, growth, markets, and we will examine each of these in detail. We will look at some of the lead indicators and macro indicators to see where the economy is headed. Thereafter, we will look at some early trends going into the Q3 results. And finally, we will summarize about the way ahead. So let's start with what are some of the challenges and worries that are facing us as we enter the new year. There has been a lot of talk about a deceleration in economic growth. As you know, the Q2 GDP figures were at 5.4%, and recently we had the government come out with its estimate for GDP growth in 24-25, which now stands at roughly about 6.4%. There's also the challenge of slowing profitability, which was reflected in the Q2 numbers, and we will see how Q3 pans out. Then there is a global challenge of rising bond yields in the US, and that's largely because of the dollar strengthening and also inflation being more sticky than what was expected. There is also in India, the inflation is sticky because largely of food inflation. And then we have President-elect Trump, who will take office on Jan 20, and there is a lot of uncertainty around what trade policies will be announced and what impact that it might have on several economies, including India. We still have the two wars in Russia, Ukraine, and in the Middle East continuing. And lastly, the usual butterflies just ahead of the budget. So let's examine that what is the recent data telling us about the health of the economy. So amongst all this worry and chatter, it is very important to keep a cool head and look at what the data is telling us. One of the worries was slowing economic growth, and we did speak about it last month, where we mentioned that amongst other things, one of the reasons of slowing economic activity was the fact that the government machinery was largely busy in elections. We had the national elections followed by state elections. We had heavy monsoons, and therefore government spending or capex was running behind schedule. Now let's look at the data, which is the latest data available up to November, right? If you look at the trends, we mentioned last time that while government revenues from April to August were at 93% of budget, government capex spending was running at 65% of the budgeted figure. Now that we have data for 2 more months, which is 3 more months, which is September, October, and November, what does the scenario look like? Well, government income still seems to be pretty much online. We are at 91% of the budgeted revenue, and from 65%, we've now inched up to 69% of the budgeted expenses. So we've covered a little bit of gap in those 2 months, but we will have to look at the data for the next 4 months, and we do believe that especially in Q4, we should see an acceleration in capex spending as we get towards the end of the financial year. So yes, we have seen some progress, but we need to see much more. Also, if you look at the trend of IIP, which is nothing but the index of industrial production, you will see that after peaking in June, July, we actually had a significant deceleration in August, where IIP virtually went into negative territory of -1. And from there, we've seen a steady improvement. And from there, we've seen that the IIP has recovered to 3.1% in September and 3.5% in October. So again, we are seeing a recovery in the index of industrial production. If we look at auto sales, while two-wheeler sales have decelerated, on the other hand, four-wheeler sales seems to be starting to recover and trending upwards, which is good news and tells you that demand is starting to recover again. When we look at GST collections, we see a pretty steady trend, a slightly upward sloping curve. Yes, December was slightly lower than November, but again, December is a slightly slow month because of the festivities. But having said that, I think the run rate for GST seems to be trending upwards. And lastly, when we look at inflation, even inflation seems to be moderating. The only problem we have is food inflation still continues to be relatively high. Now, we have seen that both our Industry and Commerce Minister, Mr. Piyush Goyal, as well as the Finance Minister, has talked about the fact that the real inflation is not in goods and service inflation, but is in food inflation, and that the RBI should take cognizance of the fact that you cannot control food inflation by keeping money supply tight. So it will be interesting to see that as the new governor comes and delivers the first policy in early February, do they really change their stance on inflation and interest rates? Now coming to the Q3 earnings season, as you all know that the earnings season is yet to start, but as is the trend, several companies do give some sort of early data or indication of how the quarter has gone by. And by and large, these early trends have come in two sectors. One is in banking and the other one is in a few consumer businesses. When we look at the data that has been put out by several banks, we see the trend that we've been talking about, that credit growth has been slowly decelerating, right? And from a peak of almost 20% by the end of March 24, through the months in 24-25, and we have the latest data as of November, we will see that the overall credit growth has fallen from almost 16% to 10.6%. And a large part of the deceleration in this credit growth has come from unsecured or personal loans. Personal loans, for example, was growing at almost 18% in 23-24, and as per the latest data, it's now down to 13%. Similarly, we've seen that lending to services and agriculture, which was roughly around 20%, is also down to mid-teens. The only area where credit growth seems to be very steady is to industry, and that growth continues to be in and around 8%. So overall, we have seen that the credit growth has come off by almost 600 basis points, and therefore our view that the big banks are seeing a deceleration in advances, largely driven by the fact that RBI does not want a runaway growth in personal lending in order to avoid another credit cycle into the future. And therefore, we believe that that is also reflected in the very tepid performance of most of the banks in the markets as well. Coming to consumers sector, and here I think there are some good news that we are seeing in some of the early trends. As you all know, because of high inflation and the fact that incomes have not kept pace with inflation, we were seeing that small ticket consumption was really struggling. But some advance data by a few companies gives us some reason for relief. For example, Jubilant FoodWorks has seen that after several quarters of almost flat to single digit like for like growth, or as they say, same store sales growth, finally in this quarter we've seen a spike to 13%, and that bodes quite well. Now, some of it I would reckon is also because companies themselves have taken some corrective actions. For example, reducing the price of their products to make it more affordable. But for all, it does seem like that we've seen a bottoming out in case of consumer demand. If you look at the jewelry companies, obviously we have a good wedding season which is underway. And again, the two jewelry companies which have come out with data, one is Titan and other is Kalyan Jewelers. If you look at the data, there has been a very strong acceleration in demand for jewelry. And lastly, if we look at a big box retailer like Avenue Supermart, Avenue, which was consistently growing at 20-22% around pre-COVID, that growth had almost fallen down to 14% in the second quarter of this year. But finally, in the current quarter, which is October to December, we've seen a growth improving from 14% to 17% year on year. So all of this data points to the fact that consumption at the lower end, which was really struggling, seems to be gradually bottoming out and improving. And that bodes well for the future as well. Then coming to the more capital intensive sectors like defense, one of the important data points that we now have is that just 2 weeks ago, we had the defense minister give out a vision of where they see defense production moving up in India. And we've spoken about this in the past, but just to give a context to the fact that we continue to believe in domestic manufacturing in the area of defense. And if you see, we have seen a consistent growth in the domestic value of production, which used to trend at somewhere in the region of 70 to 75,000 crores and ended very strongly in 24 at about 1.2 lakh crores. Now, the defense minister said that we have a very aggressive target that by 28-29, this 1.2 lakh crores is estimated to go to 3 lakh crores. And India's defense exports has also gone up very smartly. Last year, we achieved a record 21,000 crores of defense exports. And again, the government has set a target that by 28-29, this 21,000 crores should hit a number of 50,000 crores. So if you work backwards, you will see that both defense production as well as defense exports are likely to compound at a very healthy 19%. And therefore, our conviction that in this cycle, we will see a tremendous growth in manufacturing across sectors. We believe that we are on track, and what we've seen in the first half of this year is just a very cyclical deceleration. And therefore, in summary, while there are a lot of worries and uncertainty around growth, around trade policy, around monetary policy and inflation, around earnings growth, we see opportunities lying ahead. We have seen that markets are currently digesting this slowdown, and we've seen markets correct by 10 to 12%, and the broader markets also correct slightly more than the headline correction that we've seen in the Nifty. However, we see this as a great investing opportunity because markets are not about what has already happened. Markets are all about what is likely to happen. And therefore, we believe that the economy should start to re-accelerate from the fourth quarter. We believe that capex should again start, and we will start to see a slew of orders being given out in the fourth quarter. We already talked about the fact that consumer demand seems to be recovering at the bottom end. Also in rural, we are seeing a slight improvement and green shoots of demand. The new governor is now in place. We do believe that while interest rates may take a little while to trend down, but we certainly hope that more liquidity will be pumped into the system so as to enable growth to come back. And we also expect policy reforms to accelerate after the very smart win that the government has seen in the Maharashtra and Haryana elections. And therefore, a lot of you have asked us a question. Some of you have interacted with me one-on-one. But through this communication, we believe that generally, seasonally, Jan to March is always a quarter which is laden with a lot of events. There is general uncertainty, and this time more so because we have a new president in the United States who has openly and vocally talked about raising tariffs and creating some amount of trade disruption. And it is quite understandable that in the light of slowing growth, some of these uncertainties, the market seems to be a little jittery. We do believe, as I've said, that markets is all about the future and not about the past. And therefore, we believe that the glass is half full and not just half empty. And I would encourage that all of you should use this volatility in the first quarter of this year, amongst all the noise that we are seeing in the marketplace, to actually use this opportunity to invest. And we are quite confident that over the course of the year and the next few years, we believe that growth will be robust, and I think that our portfolio companies will continue to progress the way they have in the last year as well. With that, I bid adieu to this month's communication. Until next month. Thank you.